EPK Capital presents Deep Dive Cisco Systems. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Cisco Systems. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. Part 1. Introduction. The unseen engine of the Internet. Every time you stream a movie, join a video call, or refresh your social media feed, you're interacting with an invisible digital highway. For decades, one company more than any other has been the chief architect and traffic cop of that highway. Cisco Systems. Its hardware forms the very backbone of the Internet, directing the ceaseless flow of data that powers our modern world. But in an era dominated by cloud giants and artificial intelligence upstarts, is the original architect of the Internet a relic of a bygone era, or is it quietly building the foundation for the next digital revolution? Cisco today stands at a crossroads, a mature, dividend-paying blue-chip stock on one hand, and a company betting billions on an AI-powered future on the other. This analysis will dissect the numbers, examine the strategy, and weigh the arguments to help understand if Cisco represents a value trap or a deeply undervalued titan poised for a resurgence. Part 2. The Cisco story, from Stanford roots to global network dominance. The genesis of connectivity, 1984-1990. The story of Cisco begins not in a corporate boardroom, but on the campus of Stanford University in the early 1980s. Two computer scientists, Leonard Bosack and Sandy Lerner, who worked in different departments, faced a simple yet profound challenge. They wanted their respective computer networks to communicate with each other. Their solution to this problem was a revolutionary device called the multi-protocol router, a piece of hardware that could seamlessly connect disparate networks and allow them to exchange data. This invention was the spark that would ignite the Internet revolution. Operating out of their home, the pair founded Cisco Systems in 1984. The name itself is a nod to its roots, a shortened version of San Francisco, and the original logo was an abstract representation of the Golden Gate Bridge, symbolizing the company's core mission of bridging networks and connecting people. The journey was not without its obstacles. In its formative years, the networking industry was nascent, and the company faced significant financial hurdles. This led them to seek venture capital from the renowned firm Sequoia Capital in 1987 to fund their expansion. The company sold its first product in 1986 and went public with its initial public offering, IPO, in 1990, at a price of $18 per share, signaling its ambitious future. Building the Internet's backbone, 1990s-2000s. Throughout the 1990s, Cisco's growth was nothing short of explosive. As the world rushed online, Cisco's routers and switches became the essential picks and shovels of the digital gold rush, making it an indispensable player in the rapidly growing digital economy. This era also cemented a core component of the company's DNA, a strategy of acquisition and development, A&D. Rather than relying solely on internal research, Cisco has historically grown by acquiring innovative companies, having purchased more than 200 firms since its founding. Pivotal early acquisitions, such as Crescendo Communications and Kalpana, allowed Cisco to dominate the network switching sector and develop its flagship Catalyst switch portfolio, which became a cornerstone for modern enterprise networks. This strategy allowed the company to rapidly adapt and expand its product offerings. However, the company's meteoric rise culminated in it becoming one of the most valuable companies in the world during the dot-com bubble, only to see its stock price plummet when the bubble burst in the early 2000s. This event provides crucial context for the stock's long-term performance and serves as a historical lesson on market valuation. The Robbins era, a strategic pivot, 2015 present. In 2015, Chuck Robbins assumed the role of CEO, inheriting a mature, dominant but slow-growing technology giant. His mandate was to reignite growth and transform the company for the modern era of cloud computing and software-driven services. This initiated a deliberate and strategic pivot away from a business model dependent on cyclical hardware sales towards one built on more predictable, high-margin, recurring revenue streams from software, subscriptions, and services. This transformation has been a multi-year effort, involving a shift in focus to high-growth areas like cybersecurity, collaboration tools like WebEx, and cloud-based networking. The capstone of this strategy was the monumental $28 billion acquisition of Splunk in 2023, Cisco's largest deal ever. This move was designed to create a comprehensive AI-powered platform for security and observability, positioning Cisco as a critical player in monitoring and protecting complex digital infrastructures. This continued reliance on the A&D model demonstrates that acquiring its way into new markets remains central to Cisco's identity, a strategy that carries both significant potential and inherent risks. This approach, which allowed for rapid market entry in the past, has also been criticized for potentially stifling organic innovation, making it a collection of acquired parts rather than a seamlessly integrated whole, a vulnerability that agile competitors have sought to exploit. Part 3. A decade. Under the microscope, financial health and performance. A deep dive into Cisco's financial statements over the past decade reveals a company with a distinct and telling profile. It showcases the challenges of a mature market leader while also highlighting its formidable financial strength and commitment to shareholders. Revenue and profit growth trajectory. An examination of Cisco's top-line performance over the last 10 fiscal years paints a clear picture of a mature company. As shown in the summary table below, revenue growth has been largely stagnant for much of the period, often fluctuating in the low single digits. This reflects the saturation of its core networking markets and the intense competition it faces. While there have been periods of modest acceleration, the overall trend confirms the mature tech giant narrative. Net income and earnings per share, EPS, have generally been more stable, with a notable anomaly in fiscal year 2018. The sharp drop in earnings that year was primarily due to a one-time provisional tax expense related to the U.S. Tax Cuts and Jobs Act of 2017, not a fundamental collapse in the business. Excluding this event, the company's ability to generate profit has been remarkably consistent, a testament to its operational discipline. Profitability and margin analysis. Despite the challenge of top-line growth, Cisco has consistently maintained impressive profitability. Its operating and net profit margins have remained robust, frequently exceeding 20%. This demonstrates significant pricing power within its core markets, a strong brand reputation, and efficient cost management. The strategic pivot towards software and subscriptions is explicitly designed to protect and enhance these healthy margins. As higher-margin software sales become a larger portion of the revenue mix, the potential exists to re-accelerate profit growth even if overall revenue growth remains modest. Balance sheet strength and debt. Cisco's balance sheet is a fortress. The company consistently holds a massive war chest of cash and investments, often totaling tens of billions of dollars. This financial strength provides immense strategic flexibility, enabling large-scale acquisitions like Splunk, funding significant R&D, and weathering economic downturns without financial distress. While the company does carry debt, its debt-to-equity ratio has remained at manageable levels for a corporation of its scale and cash-generating capability. Shareholder value creation, the dividend champion. A central pillar of the investment case for Cisco is its unwavering commitment to returning capital to shareholders. The company initiated a dividend in 2011 and has increased its payout every single year since, a streak of 13 consecutive years of growth. This track record has made it a favorite among income-oriented investors. The company's dividend payout ratio which measures the percentage of earnings paid out as dividends, typically hovers around a sustainable level, leaving ample capital for reinvestment in the business. This dual identity, a technology company that behaves like a reliable income stock, creates a unique valuation question. Is it a cheap tech stock or an expensive utility? The answer hinges on whether its strategic pivot can successfully reignite growth. Part need reading charts a technical perspective on CSTO. While fundamental analysis tells us about the health of the business, technical analysis provides insight into market sentiment and how investors are currently positioning themselves in the stock. The long-term narrative. A look at the multi-decade stock chart for Cisco is a study in market history. It shows the monumental peak in the year 2000 during the dot-com bubble, followed by a dramatic crash. For over 2 decades, the stock has been on a long, slow road to recovery and, remarkably, has yet to reclaim those all-time highs. This long-term context is crucial as it has shaped the perception of the stock for an entire generation of investors. Focusing on the last 10 years, the chart reveals a more constructive picture. The stock has been in a general uptrend, characterized by steady advances, punctuated by periods of sharp corrections and lengthy consolidations. This pattern reflects the ongoing push and pull between its stable, cash-generating business and its struggles with meaningful growth. Key battlegrounds: support and resistance. Technical analysis identifies key price levels where buying or selling pressure has historically intensified. For Cisco, current analysis points to a significant level of technical support around $64.80 and a key resistance level near $71.70. In simple terms, support acts as a potential price floor where buyers have previously shown strong interest, preventing further declines. Resistance, conversely, acts as a price ceiling where sellers have historically taken profits, stalling upward advances. A decisive break above this resistance or below this support could signal the start of the next major trend for the stock: momentum and sentiment. To gauge the current momentum, analysts often turn to indicators like the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements on a scale of 0 to 100. It helps identify overbought or oversold conditions. Recent analysis of Cisco's chart has pointed to a potential negative divergence. This occurs when the stock's price reaches a new high, but the RSI indicator fails to do the same. This can sometimes suggest that the underlying upward momentum is weakening and that the stock may be due for a period of consolidation or a pullback. Part V. The Intelligent Investor's View, a Benjamin Graham valuation. Graham provided a formula to estimate a stock's intrinsic value based on its earnings and book value. Intrinsic value, 22.5 EPS x BVPS. Using the trailing 12 months, TTM diluted EPS of 2.61 for fiscal 2025, and a book value per share, BVPS, of 1160, we can calculate the Graham number 11, value, 22.5 BAV 2.61 11.60682.47 toward 26.12. The verdict. Comparing this calculated intrinsic value of approximately $26 to the recent market price of around $67 reveals a significant gap. From the perspective of this classic asset-focused valuation formula, Cisco stock appears to be substantially overvalued. However, this calculation comes with a critical caveat. The Graham number heavily emphasizes book value, which primarily accounts for tangible assets. For an industrial company in the 1950s, this was a reliable measure of value. For a modern technology company like Cisco, its most valuable assets, such as its powerful brand, its vast portfolio of intellectual property, its deep-rooted customer relationships, and its growing software business, are intangible and not fully captured on the balance sheet. Therefore, a purely asset-based framework may systematically understate the company's true economic worth, making it a useful but incomplete tool for analysis. Part 6. The Bull versus Bear Debate, the Future of Cisco. The investment case for Cisco today is a tale of two competing narratives. The bull case is forward-looking, focused on a strategic transformation and new growth catalysts. The bear case is rooted in historical performance and the challenges of its massive scale. The bull case, reasons for optimism. AI as a generational growth catalyst. The most powerful argument for Cisco's future is its essential role in the AI revolution. AI models and applications require an unprecedented amount of networking capacity and performance. Cisco provides the high-performance Ethernet switches, optics, and custom silicon, Silicon One, that form the critical infrastructure for AI data centers. This is not speculative. The demand is tangible. In fiscal 2025, Cisco's AI-related orders surged past $2 billion, doubling its initial target. Strategic partnerships, particularly with AI leader NVIDIA, further solidify its position in this burgeoning market. The recurring revenue engine, the pivot to software and subscriptions, is bearing fruit. These more predictable and higher-margin sources now account for 54% of total revenue, with annualized recurring revenue, ARR, reaching over $30 billion. This fundamentally changes the quality of Cisco's business, making it less susceptible to the boom and bust cycles of hardware upgrades and providing a stable foundation of cash flow. The Splunk synergies. The acquisition of Splunk is a transformative move that creates a powerhouse in cybersecurity and observability. By combining Cisco's network visibility with Splunk's data analysis capabilities, the company can offer an end-to-end platform for securing and monitoring complex IT environments, a massive and non-discretionary area of enterprise spending. A fortress balance sheet and shareholder champion. In a volatile market, Cisco's financial stability is a significant advantage. Its massive cash reserves and consistent growing dividend provide a margin of safety and a reliable return stream for investors, making it a defensive holding within the tech sector. The bear case, reasons for caution. The law of large numbers. The core challenge for Cisco is its own success. With a revenue base of over $55 billion, generating growth that is meaningful enough to excite investors is incredibly difficult. Long-term revenue performance has been described as flatter than a pancake, and overcoming this inertia requires monumental effort and success in new ventures. Intense competitive threats. Cisco is fighting a war on multiple fronts. In its core networking market, it faces pressure from more focused and innovative competitors like Arista Networks, which was founded by former Cisco engineers. In the high-growth cybersecurity space, it competes against specialized leaders like Palo Alto Networks and Fortinet. The risk is that Cisco becomes a jack-of-all-trades, master of none, unable to compete effectively against best-of-breed solutions in each category. Declining returns on investment. There are concerns that Cisco's ability to generate profit from its investments is weakening. Analysis has pointed to a declining return on invested capital, ROIC, which could signal that new acquisitions and projects, including the massive bet on Splunk, are not yielding the same level of profitability as past ventures. This directly challenges the bull case's reliance on the A&D strategy for future growth. Valuation concerns. Despite its modest growth profile, the stock is not always a bargain. Its PE and price-to-sales ratios can trade at levels that some analysts consider stretched, especially when compared to its growth prospects. This suggests that much of the optimism around the AI story may already be priced into the stock. Ultimately, the entire investment thesis for Cisco hinges on a single question. Can the high-growth AI and software segments grow fast enough to offset the slow or no-growth legacy hardware business? The bull case bets on the new engines, while the bear case points to the heavy anchor of the core business. The outcome of this race against time will determine the stock's trajectory for the next decade. Part 7. Essential due diligence, controversies and competitive landscape. A thorough analysis requires an examination of the risks that don't always appear in financial statements, including legal battles and the competitive environment, legal and reputational risks. Cisco versus Arista Networks. Cisco was embroiled in a multi-year legal war with its rival Arista Networks. Cisco alleged that Arista, which was founded by former Cisco executives, had infringed on its patents and copied its command line interface, CLI software. The dispute was complex, involving proceedings in federal court and before the International Trade Commission. It ultimately concluded in 2018 with a $400 million settlement paid by Arista to Cisco. However, a key part of the battle was a jury verdict that found Arista was not liable for copyright infringement, based on a legal doctrine known as sans-affaire. This doctrine suggests that Arista's use of similar commands was permissible because they had become an industry standard and were essential for functionality, rather than being a unique creative expression belonging to Cisco. China surveillance allegations. A more serious and ongoing controversy involves allegations that Cisco knowingly assisted the Chinese government in building its sophisticated internet censorship and surveillance system, known as the Great Firewall. A lawsuit alleges that the company custom-built technology to help authorities track and persecute members of the Falun Gong religious minority, leading to their arrest, torture, and death. A U.S. Court of Appeals has affirmed that Cisco can be held liable for aiding and abetting human rights abuses, allowing the case to proceed. This represents a significant legal, financial, and ESG, environmental, social, and governance risk for the company. The outcome of the Arista lawsuit reveals a critical threat to Cisco's business model: the potential commoditization of its core technology. The legal argument that its CLI was an industry standard strikes at the heart of its historical dominance, suggesting its technological moat is not as defensible as once believed. This reality underscores why the strategic pivot to more defensible software and security platforms is not just an offensive growth strategy, but also a necessary defensive maneuver. Market position and moat. Cisco's primary competitive advantages, or moat, are its globally recognized brand, its massive installed base of equipment in enterprises and data centers worldwide, and its long-standing customer relationships. However, this moat is under constant assault. Its key competitors include networking, Arista Networks, Hewlett-Packard Enterprise, Juniper Networks. Security, Palo Alto Networks, Fortinet. Collaboration, Microsoft, Zoom Communications. The nature of the competitive threat is one of specialization. While Cisco offers a broad portfolio, its rivals often provide best-of-breed solutions in specific niches, allowing them to innovate faster and capture market share in the highest growth segments. Part 8. Concluding Analysis. A synthesized view of Cisco Systems. So, what is Cisco Systems today? It is a company of two minds. On one hand, you have a legacy behemoth, a cash flow machine with a reliable, growing dividend, but one that has struggled for a decade to meaningfully grow its top line. On the other, you have an aggressive, forward-looking company making a multi-billion-dollar bet that it can become an indispensable partner in the AI revolution. The bull case is compelling, centered on the tangible surge in AI-related demand that plays directly to Cisco's core strengths in high-performance networking. The successful transition to a recurring revenue model adds a layer of stability and profitability that is hard to ignore. The bear case is equally grounded in reality, pointing to the immense challenge of moving a $55 billion revenue ship, the persistent threat from more agile competitors, and a valuation that may not fully account for these risks. Ultimately, an investment in Cisco is a bet on the success of Chuck Robbins's strategic transformation. It is a belief that the growth from AI, security, and software will not only be sustained, but will accelerate to a pace that can finally lift the entire company into a new era of growth. The risks, from intense competition to serious legal and ethical challenges, are not insignificant. As always, the final decision rests on an investor's own research, risk tolerance, and investment timeline. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.